Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today's episode 166, Taxes in Retirement. Cory, thank you for joining me back on the show.
Thanks for having me. One of these days, I'll return the favor, Jake.
Yeah, it's interesting. This is the second time, maybe in 5 episodes, that you've been on my show. However, I still haven't gotten an invite onto your show. Interesting how that works. I thought it
got lost in the mail.
Thought it was give to receive kind of thing, but
that invite must have got lost in the mail.
You just love talking to yourself, don't you?
Evidently. My wife would probably agree with that.
Well, thank you. Thank you for joining me back. And we hope all of you out there are staying safe and healthy during this horrible pandemic. For today's topic, Cory, I wanted to have a conversation about taxes in retirement. For many retirees, they've worked 30, 40 years only to find out that the tax man is still going to want his due. But there's some things that they can do, these retirees, to help mitigate that tax liability in retirement. And I know you've recently done a show or two about taxes in retirement. So first off, I just want to kind of kick it off. Maybe, again, in your last show, didn't you talk about some, and forgive me, shame on me, I haven't watched it yet, but didn't you talk about some retirement tax myths or something from that?
Talked about 3 retirement tax traps.
Tax traps. Okay. Why don't, and rather than just regurgitate your whole show, why don't you give us the number one takeaway on that as we lead into taxes in retirement here?
The number one takeaway is that when someone reaches age 72 and they're required to start taking distributions from their pre-tax retirement accounts, that additional taxable income that is created can result in not only the individual having to pay more money in taxes, but it can also result in more of their Social Security income being taxed. And it can also increase the cost of their Medicare premiums.
Yeah, really good point. Yeah, so everyone out there listening or watching, if you have an IRA, right, or even a 401k and you're not working,
yep,
and when you turn 72 years old, it's some magic number with the IRS, you're going to have to take what's called a required minimum distribution, or RMD for short. And what Cory's getting at, for many people, this could potentially even bump you into a higher tax bracket, right, and cause some other headaches for your overall tax situation. So one thing that we do at Falcon Wealth Advisors as part of our projected tax planning is we will start converting some of that some of those IRA dollars into Roth IRAs, so that requirement later in life when you're in your 70s is much lower than what the current projection is. Now, what's important is you don't want to try to do this alone. You definitely want to work with a chartered retirement planning counselor such as myself or Cory, and you also want to cross-check this with your CPA because it gets a little bit into some nuances. And again, we're not holding ourselves as tax advisors at Falcon Wealth Advisors, so please double check these things with your tax professional. Very good takeaway on that one, Cory. Another big, I think, misconception, this was probably in your show, is that many people don't understand that Social Security, if you make up to a certain limit, is actually taxable as well, which people get annoyed by. And I don't blame them, frankly, because they're already pulling it out of your paycheck all these years. It's not really a tax. Like, they're basically pulling money and putting it into a fund. And I wish they were putting it into a fund. It's actually, they're putting it into other retirees' pockets while you're working, right? So you and I that are paying Social Security tax or whoever, that's going into paying current retirees' benefits. And then when you go to retire, if you make too much money, up to 85% of your Social Security can actually be taxed, which is crazy. But
and that number for most of our clients, just to kind of chime in on that too. I mean, for a married couple, that number is like $44,000.
Right.
So if a married couple's taxable income exceeds $44,000, then up to 85% of their Social Security benefits are taxable. So for most of our clients, frankly, that's the case.
Right. So again, so good. So switching gears a little bit, and before I do that, actually, quick plug to your show. For everybody that's watching or listening to this, Cory has his own podcast that comes out weekly called In the Money Insight. You can find it right here on our YouTube channel, Falcon Wealth Advisors Collective. If you're not already subscribed, please do that. That's the best way to make sure you don't miss either of our episodes. And if you like our content, let's give it a thumbs up, right? So thank you. But what can so let's say somebody's watching this show, Cory. and they're not 72. So
yeah, I wanted to share one other just fun fact right before you move on about Social Security. So in 1983, the Reagan administration, that is when Social Security was in pretty dire straits, like it's projected to be in 12 years or so. 1983, one of the changes to the Social Security program is actually when they introduced taxing Social Security. Prior to that, they didn't, and that's one of the ways to help sustain the program. But we're not necessarily here to talk about Social Security. I just thought that's a fun fact.
Yeah, look at you, a little bit of a historian. How old were you in 1983, Cory?
I was a twinkle in my father's eye.
So you don't even know. I was 2 years old. 2 years old. All right. So moving on, Cory. Do you want to talk more about Social Security?
Nope.
All right. Do you want to be a Debbie Downer more about Social Security and taxation?
I don't.
Okay, good. All right. So, but what can somebody do? So what I want to talk about, what can somebody do? Let's say whether they're retired or not, many of our clients aren't 72 years old yet. So what can they do? Well, first off, let's talk about the people that are still working. So maybe you're in your 40s or 50s or 60s and still working. There's some things that you can do to better prepare yourself for taxes in retirement. So, and I want to be careful here because a lot of CPAs out there, right or wrong, I think they're very focused on your tax return in that given year. And they're all about trying to, even if they do some tax planning, normally they're looking at how can I lower your taxes as much as possible this year? And how can we just defer, meaning put money in your 401k or your IRA, lower that tax liability this year. And that's all fine and dandy to some extent. But at Falcon Wealth Advisors, we take a little bit of a different perspective on it, is that it's okay to defer taxes today, but you have to understand that important word in this comment is you're deferring it. You're not deleting them. So while you may be lowering your taxes now, you're just potentially causing a much bigger problem when you're 72. So for many of our clients, especially now, because the tax code's all up in the air, and if you notice, I haven't talked about it much on Falcon Wealth Advisors because first of all, I don't like to get into politics, and two, we don't know what it is, so I'm not going to waste my time speculating. It drives me crazy, Cory. Quick side note, that all these people are out there doing webinars and writing papers and blogs about it. Nobody knows what the tax code is going to be. So why are they all getting ruffled about it? Do you understand that or no?
My best guess is that there's people that feel compelled that they have to do that because people want answers, but they're asking questions that can't be answered.
Right. So I don't even waste my time with it. So rest assured, out there, if you're tuning in, it's not that we're ignoring the proposed tax changes. It's just I'm not wasting too much time talking about it because it's not law yet. When it's law, we will dive deep in and we will be talking about it. But today, it's all speculation. So again, going back to our pre-retirees, Cory, is we want them to lower their taxes, but maybe you can talk about some other things that they can do so that when they're 72, they don't have $4 million all in a pre-tax IRA, and now they're having to pull out $160,000 a year for their RMD or required minimum distribution. So what are some things that you talk about with your clients as far as setting themselves up to have a more flexible tax situation in retirement?
Sure. One is making Roth 401k contributions. If someone works for a company that provides the Roth option inside their 401k.
Now, why a Roth 401k, not just a regular Roth IRA?
One, because a regular Roth IRA, the dollar amount that you can put in annually is a lot less. But secondly, there are income restrictions around who can contribute to a Roth IRA. So if your income is too high, you can't make Roth IRA contributions. But as far as a Roth 401k goes, there are no income restrictions. Doesn't matter how much money you make. And you can put the same amount of Roth dollars in a 401k that you could put pre-tax in any given year.
Right. Good point. Okay, good. So building up that Roth, even if you're in a high tax bracket?
It depends on how high. I think to your point though earlier about deferring, but it's not deleting, right? Is knowing that we're going to have to pay the taxes, or even our clients' beneficiaries are going to have to pay the taxes on the dollars. The whole idea is just trying to think about how to, minimize the total taxes paid over a client's lifetime, even the total taxes paid on the dollars that they saved that ultimately children might inherit. With the whole idea being if, we can keep someone in it might be a higher tax bracket today, but a lower tax bracket in the future if it's smoother, over the next 20, 30, 40 years.
Right. And for longer, right? So again, you're in a high tax bracket, this year, but hopefully the next 30 years, you'll be in a lower one. And even if you are or aren't, that money's going to grow tax-free regardless. But the big kicker with that is though, and clients, I've had some of these questions are like, is Biden going to try to change the tax laws of IRAs, or what if he makes Roth IRAs taxable? Then what do we do?
Don't know. I don't think that's going to happen, but
I don't think it's going to happen either. And again, that's why we don't get into too much speculation, because it would be extremely politically unpopular for any politician to do that, because the amount of individuals that have participated in IRAs and Roth IRAs, that I just feel like it would get voted out. It'd be like if he wanted to do away with Social Security.
Right.
Well, nobody's going to be okay with that.
No.
Or certainly not all the baby boomers that are getting ready to collect or are collecting.
My best educated guess would be if the government had concerns about Roth dollars, that there would be more restrictions around how much can go in and who can save them, as opposed to treating the taxation of distributions on people that have already put money in a Roth differently.
Yeah, but you never know. And so, another way around that, though, even is, and one of the things that I comment on with my clients is that I'll tell them, sure, the Roth is fine, but why not just build up money in a brokerage account, which is taxed as you go. It's subject to capital gains. So if you own a position less than a year, it's short-term capital gains. If you own a position longer than a year, it's long-term capital gains. Long-term capital gains rates are still very manageable, and even this hint of them raising them will still be actually quite manageable. So I like doing that as well. So I think you're right with the Roth 401k, but I also like that brokerage account, because again, the brokerage account, I don't think will be picked on as much, because it's just an account like anybody, it's just like a savings account or anything else. So it's like, if they're going to pick on brokerage accounts, they're going to have to start picking on all kinds of accounts out there as well. Right. So I think the Roth is intriguing and a great option. Many people also don't have Roth 401k, so they don't even have that choice. So if you don't even have that choice, again, doing a brokerage account, just putting money in there, being subject to capital gains isn't the worst idea either.
Right. Absolutely. Those are the two items typically that I will talk about. And again, depending upon someone's income or situation, some clients, even while they're still working, will consider Roth conversions also, if it makes sense to do that. So converting pre-tax
while they're
dollars to
working,
Roth while they're working, it depends upon their income.
Yeah. And I typically steer away from that. And again, every client situation is different, but I call it this retirement sweet spot. I don't like to convert from an IRA to a Roth until they're retired, our clients retired, because then they drop down in a tax bracket, hopefully, and then we can do that conversion under a different level. But you're right, maybe one of the spouses is retired, and so they're already in a low bracket, or maybe they just don't. Maybe they're just not in a high bracket, so they can convert now.
Exactly.
If someone, let's say they're 50 and they want to work till they're 70, right? Why not convert some IRA now? Because you're talking hopefully a 40-year, 50-year time frame. So why wait till they're 65, 70 to convert? So I hear you. And again, every client situation is different, but I like this sweet spot typically, not always, but typically. You retire at 60, you have till 72 until you have to do your required minimum distribution. Let's start. And what Cory's talking about is we're taking money from an IRA and we move it to a Roth. Now, the kicker, though, is anything you convert in that year will count towards your taxable income. And so that's what we're talking about. So you want to be careful of that, because again, if you already make a lot of money and then you convert, you're just adding to your taxable income. But when you're retired, if you don't have much taxable income and then you convert, maybe you can keep it under a lower bracket.
Exactly. And I think back to the point just quickly here about Roth conversions, if someone is still working, what I'm kind of getting at there, Jake, and the way that I think about it is, let's say if someone has another $50,000 in taxable income that they can realize and stay in the same tax bracket that they're already in, whether they're working or retired, the argument could be made if, who knows what the future tax brackets and tax code is going to look like. But if somebody can convert dollars while they're still working and it keeps them in the same tax bracket, something to consider.
Right. Good. And then leading on into this subject here. So again, planning for taxes in retirement. Another thing that I've seen work rather successfully for our clients is bunching into a donor advised fund. And so what a donor advised fund is, it's a charitable account that you establish. And the idea is that money you put in there can potentially be deducted from your taxes as long as you're over the standard deduction. You can keep it invested and it grows tax-free as long as you give the money ultimately to a qualified charity or a 501c3. So what I've done is, in that final year or two of a client's approaching retirement, we've put a lot of money into these donor advised funds, right? $50, $100, $200,000, right? To lower that taxable income, because the idea is they're going to be in a lower bracket in retirement. So why not take that tax deduction now while they need it? And now they've got a nice big bucket of money that they can give to charity over the rest of their lives. And they don't have to worry about touching bucket over here, their retirement money. So what I've done is to set them up to lower their taxes while they're in a high bracket, and then eventually give to charity and not worry, because they probably won't be able to deduct anything in retirement. Maybe some clients can, but a lot of them can't, because they don't have anything. They have a mortgage, but maybe the interest isn't enough to deduct, or
they don't even have a mortgage.
Right,
Yeah.
right. So I love using these donor advised funds. So if you're charitably inclined and you're not using a donor advised fund, I have a big question mark, because again, these things are very, very powerful accounts. You can think of them almost like a Roth IRA that you get to deduct. And so that's like the best of both worlds, but again, it's an irrevocable gift, meaning you got to give that money to charity. So this shouldn't be used just to lower your taxes, Cory.
Right. The best part though about the donor advised funds, that I don't think you mentioned yet either, Jake, is that you can donate appreciated stock.
Oh, good point. Yeah. So if you bought XYZ stock and you've doubled it in a brokerage account, but you don't want to pay capital gains, great call, Cory. Put that in the donor advised fund. Not only do you potentially get to write it off based on your tax situation, you also don't have to pay the capital gain, which is awesome.
I met just this week with a client that had a handful of stocks that were purchased probably 30 years ago in a brokerage account, where they're up, some of them, the positions are up 5,000+%. And we were talking just about this. Those would be the perfect shares to donate to a donor advised fund if somebody's charitably inclined, and it makes sense because they don't have to realize those capital gains.
Right. Very good. And the last one I wanted to talk about leading into retirement or health savings accounts, right? And a lot of people don't utilize those. And believe it or not, all you need to be eligible is a high deductible health insurance plan, right? So even if your employer currently doesn't offer an HSA or health savings account, but you're in a high deductible plan, we can actually open one of those accounts for you at Falcon Wealth Advisors. You have to jump through some hoops, and it's a little bit tedious, but it can be done. It can be done. And the perk with this is that, similar to the donor advised fund, you can put money in there, potentially lower your taxable income, invest it, grow the money, and as long as you use it for qualified health expenses later down the road, or even the next year, whatever you want to do, it's not taxed to you. And you can actually contribute to a health savings account even if you're retired up until you turn 65. Now, the one kicker is you can't use a health savings account to pay for certain parts of Medicare, but that's okay, because you're probably going to have other health expenses anyways. And worst case, if you don't need the money in your health savings account when you do turn 65, it does act like an IRA. So worst case, it's an IRA account that you could just pull from and pay taxes on as income like you would an IRA. So it's not like you lose the money. So health savings accounts are these kind of neat little accounts that a lot of people don't use, that can really be leveraged to help you set yourself up for lower taxes in retirement.
It should really probably be considered the third retirement account, right? If you have a 401k / pre-tax IRA, Roth 401k, Roth IRA, HSA. Belongs in that conversation the same way 401ks and IRAs do.
Absolutely. Yeah, absolutely. They're very neat deals. They I think, and maybe this is me speculating a little bit, but I think the political arena also would be less likely to penalize those accounts, because they're supposed to be used for health purposes. And I don't think the government wants to have more of a health liability on Americans than they already do, right? So the point is, if Americans are saving for their own health needs, I don't think the government's going to pick on those accounts as much as a Roth IRA, for example, or an IRA, right? Because all it's doing is help the government pay less for our medical, right? If more people have money saved up for their own, maybe again, this is me speculating a little bit, but I think they're a great account. There's limits. If you're single, you can only put $3,600, and if you're married, you can only put $7,200. So it's not like you can put hundreds and hundreds of thousands of dollars in these things. That's one of the issues. And even the donor advised fund, there's certain caps based on how much you can deduct and how much you make. But the idea is, if you're lining all these accounts up before you retire, you have a lot of different buckets to choose from in retirement. Okay, so let's to kind of close our show here, let's talk about the client that's already retired. But before I get into that, a quick plug: both Cory and I are on 4 social media platforms. So if we're not already connected on Facebook, LinkedIn, Twitter, or Instagram, please feel free. Send both of us a friend request. We both love expanding our network. And our company, Falcon Wealth Advisors, is on the same 4 platforms. All right, good. So Cory, why don't you segue us in here? So let's say somebody, okay, that's all fine and dandy, Jake, but I don't have a 401k anymore because I rolled it over to you guys at Falcon Wealth Advisors. HSA sounds intriguing. I may do that. Don't have any income, so I can't put money in a Roth. What's the retiree to do? And let's say they're not 72 years old yet. What are they to do about their taxes in retirement?
Great question. So in that situation, you talked earlier about that retirement sweet spot, right? So 60 to really 72, right? When the required minimum distributions begin. What we can do from a planning standpoint is figure out if, maybe if we're not looking at something like Roth conversions. I've even had conversations with clients that have just started to accelerate IRA distributions, just taking more money out of their IRA, even if it's going in a taxable account and reinvesting it, if that makes more sense. Paying the tax now, taking the money out of the account, reinvesting it in an after-tax account. But if those IRA distributions are going to keep them in the same tax bracket that they're already in, why not take the money out now when we know what the tax code looks like and we know that the RMDs are looming?
Yeah, absolutely. That's a really good point. So again, it's managing this sweet spot and then juggling that tax bracket every single year. And ultimately, making sure their cash flow is set up appropriately and being taxed that way. And that's the big problem. And actually, maybe it's a little bit of job security for us, but again, we're projecting out many of these plans 30 years,
right.
And the tax code, I can almost promise you, right, that it's going to change in 30 years, right? So as that tax code change, as estate planning rules change, right, we can talk about these things and adjust the plan accordingly. The big thing, though, with us at Falcon Wealth Advisors is we're not rip the Band-Aid guys, right? We typically aren't going to say, well, Mr. or Mrs. Client, you've got $1 million in your IRA. Let's convert $1 million to your Roth this year and pay taxes on all of that. I mean, to me, that's very extreme when advisors do that. And they're playing with fire because not only are the clients going to pay an extremely large amount of taxes that year, who knows if the rules change and they've actually messed things up more than they've helped them. So maybe this is just the way that I'm built, but I'm all about incremental changes that'll make big shifts down the road. So if we can do some little things today and stay disciplined and focused on it and then tweak it and make adjustments as we go, the goal would be to make a big difference down the road. And that's really, I think both you and I, the mentality that we take with our clients.
Methodical.
Yeah. So again, when you're in retirement, tax planning doesn't stop. We just want to make sure we're leveraging the accounts that we can, and then we're making smart decisions. And then as the rules change, that's what, your friends at Falcon Wealth Advisors, that's what we're here for. And ultimately, Cory, clients choose to work with us to enhance their financial literacy and explain exactly what their financial plan means to them. And that's what really this show is all about, and your show is all about, and why we meet with our clients.
Yep, that's exactly right. One more quick fun fact for you, Jake.
Thank you. Please.
Just as a thought exercise, Joe Ibarra, shout out to Joe on our team in our financial planning group, who is a CPA. I joke with him, he's a recovering accountant on our team. But Joe and I have looked at for a couple of clients, really just as an exercise and talking through the clients. What if, back to what you said earlier, if somebody had $1 or $2 million in an IRA, just out of curiosity, I've looked at it. What if they converted everything in 1 year?
Yeah.
What impact does that have on the plan? Now that can't take into consideration what the future tax code looks like, but assuming all things remain equal. Interestingly, the real short answer to what that looks like is that someone has to live for a long time for that to make sense.
Got it. Because again, they're putting a huge dent in it. So you've got even longer time.
You're going to have tax-free growth for a long, long time.
Like how long? For an example, and one of the scenarios, I know everybody's different. But
if someone is 55, as an example, it might be 85 or older before it actually starts to, before the math actually starts to make sense, where it becomes an advantage. So it's something we can look at and think about. But like you said, that's one of the many reasons that we're not extreme in that regard, that we want to be methodical.
Right. And hopefully, obviously that happens, but you're right. That's just, you're going to have to wait 30 years for this strategy to play out. And who knows what's going to, and what if that client needs that money in 30 years? And then you've just completely blown up what you've done.
Yep, exactly.
Yeah, good point. Well, thank you, Cory, for joining me back on the show. I've started doing Chiefs predictions on this thing, but they've lost. They lost to the Bills last time I did this. So I'm done. No more Chiefs predictions. I know your Cardinals are out of the playoffs. I know that was a heartbreaker for you. I haven't watched hardly any baseball this year. What's going on? Are you still watching? Who's in the playoffs? What's going on with baseball?
I am. So I'm saying well, Cardinals just fired their manager yesterday, interestingly,
Wow.
but that's a whole nother conversation. Boston. So the Red Sox beat Tampa Bay, the Rays. So the Red Sox have already advanced.
They're going to the World Series? The Red Sox?
No. They're going to the ALCS.
And who are they going to play?
They'll play either Houston or I'm drawing a blank on who Houston is.
Is it the White Sox? Is it somebody
Yes.
from the?
And Houston might have already won that series, actually.
So it'll probably be Houston and Boston. And didn't Houston cheat
in 2017?
Oh, that's been that long?
Mm-hmm.
Okay.
The year that they won the World Series is the year that they were exposed for.
It's been that
cheating.
long since they cheated?
Yep.
Wow.
I think it
who's
was
on the National League? Nobody cares about the National League, really, but who's in the National League right now? The Dodgers?
The Dodgers and the Giants. I think they actually played Game 5 last night.
The Giants are good again?
Yeah.
Wow.
They won like 107 or 108 games this year.
Wow. Good for them.
And so did the Dodgers.
Do they still have Bumgarner? Do the Giants still have that guy that
No.
hurt the Royals? No.
No, he's on Arizona now, the Diamondbacks, I think.
That guy's good.
Yep. So, and then the Dodgers or the Giants, whoever won last night, I don't know yet. I didn't look. It was late at night. They are playing Atlanta, the Braves.
Okay.
I think
it's just tough. If it's not the Royals, it's really hard for me to watch.
And I don't watch any of those games. I just kind of keep up with.
Yeah, you track it.
Keep in touch with it. So.
Got it. Well, I know you've got to run here, but thank you again for joining me on the show. I hope all of you out there are staying safe and healthy. Thank you so much for tuning in to our content, and we hope you all have a great week.